Okay, well, hello everybody and welcome. Thank you so much for joining us here today. We have a fabulous program. This is the 2022 year-end planning opportunities and a whole lot more. The presentation is about 30 minutes, and then we will take Q&A at the very end of our presentation. Next slide. Okay, so if you do have a question, at the very bottom of the screen is a Q&A box. If you would simply just type in your question at the bottom where the Q&A icon is, I promise we'll try our very best to get to every single question at the end. Thank you. Important disclosure information, nothing new, nothing different. There's another slide on this as well. And thank you, Sam. Okay, so how we're going to proceed here is Sam is going to go through the various agenda as noted here. We're going to cover all these topics in as much detail as we can. We would encourage you to schedule a follow-up in person, ideally, or if not by Zoom or by phone. This is a great opportunity, and there's a lot of nice things that you're going to learn about here today. Again, questions, we'll take those at the very end. And without further ado, Sam, please jump right in.
All right. Thank you for that introduction. And yeah, let's get right into it. The first topic that we're going to be going over today is inflation. This is the biggest focus of the financial world. It's what you're hearing about on TV. It's what you're seeing in the newspaper. It's what you're noticing when you go to the gas pump or the grocery store. And it's really been a major focus, most importantly, of the Federal Reserve as well. So let's discuss where we're at and where we think we might be headed. So what we're looking at here is a graph which shows how inflation has changed since November of 2021 through the latest reading we got, which was of October of this year. So based on the data points that we're seeing, it appears, at least at the moment, as if inflation has peaked in June, where we got a reading over 9%. And over the 4 months that have followed, we have slowly seen a steady decrease in inflation. So housing rents have accounted for nearly half of the overall rise in consumer prices in October, and we expect it to continue to be a key driver for inflation in 2023 and 2024, because they make up more than 30% of the overall CPI, which is inflation, and still have a long way to go to catch up to home prices, which have skyrocketed during COVID. Digging into the core data show inflation was held down by a handful of categories that declined in October, with one major caveat. The caveat came from the category of medical care services, which declined 0.6%, the largest drop for that category in more than 50 years, 50. But that was due to the way the government tracks healthcare prices and makes adjustments once a year, which happens in October, based on how often people go to the doctor. This drag on overall and core inflation should not be expected to repeat in the months ahead. Other categories that declined in October were for prices for used vehicles, down 2.4%, airline fares down a little over 1%, and apparel, which was down 0.7%. While October's report may be a welcome sign to the markets, make no mistake, the Fed still has a long way to go before it can say that the inflation scare is over. And just to make sure that we're on the same page, the Federal Reserve's inflation target is 2%. So the good inflation reading, if you will, from October showed us at 7.7. So we are still a far cry away from where the Federal Reserve and where us as a society would like to see it. Now, that's not to take away from the good news that we've seen trending, but we are proceeding with caution, that we still have a long way to go. The Federal Reserve still has a long way to go in this inflation battle. While we're starting to see a lot of encouraging signs, is still far from over. So now let's jump into interest rates in terms of one of the tools that the Federal Reserve has used thus far this year to try and combat inflation. So what we're looking at here on the graph shows what the federal funds rate has shown from the beginning of this year through November. Now, the Federal Reserve has raised interest rates 6 times so far this year, and they will likely raise rates again at their December meeting. This has been the most aggressive interest rate increase cycle over the last 30 years. Now, as I just mentioned before, they've been raising rates to combat inflation. Interest rate increases are intended to slow down the economy by making borrowing more expensive for businesses and individuals. An example of this may be a new car purchase. If you are going to take out a new car loan and the interest rate that you're going to have to pay is significantly higher, that may reduce how much money you're able to actually put into a car, thus forcing car manufacturers and dealers to lower their prices. To give you one example of how an increase in interest rates actually works its way through the economy and trying to stimulate lower prices. The Federal Reserve Chairman, Jerome Powell, in his November press conference said it is very premature to think about pausing. They're going to err on the side of over-tightening rather than under-tightening in order to avoid the risk of inflation becoming entrenched. In response to these comments, the futures markets are now pricing in a rise of the federal funds rate to 5% to 5.25% area by the second quarter of 2023, with the rate staying above 5% throughout the entire year next year. Now, while we've become very accustomed to very low interest rates since the great financial crisis of 2008, from a historical standpoint, having a federal funds rate at this level or slightly higher from where we're at now has been common. And in fact, for those of you that were even purchasing homes back in the 80s, know that mortgage rates were in the teens. I've heard stories of 14 to 18%, and the federal funds rate was also very high during that time. So while the federal funds rate is significantly higher than we've seen in some time, from a historical standpoint, it has not reached extremely high levels. And ultimately, the Federal Reserve, as we've talked about, needs to keep their foot on the pedal to make sure that inflation stays under control and we don't start to trend back in the other direction. So now let's take a look at the economy. With increasing interest rates, the Federal Reserve is trying to tackle inflation. And one of the tools that they're trying to tackle inflation is by slowing the economy down. And so what we're looking at here is a graph which shows the leading economic index going back to the beginning of the century, so 2000 through September of this year. Now, the leading economic index is a predictive variable that anticipates turning points in the economy by around 7-ish to 9-ish months. It has 10 components. Some examples include average weekly hours in manufacturing, average weekly initial claims for unemployment insurance, manufacturers' new orders for consumers' goods and materials, building permits, the S&P 500, etc. And so what we're seeing here on the graph is we have dipped below what is shown to be a recession signal in the past, leading us to believe that we might encounter a recession at some point in 2023 or potentially at some point in 2024. While I know that the chart that we're showing you right now makes it look like it is an absolute certainty, of a recession coming up here in the next, again, 7 to 9-ish months, we could go farther back and show you some data to where it doesn't match up, necessarily perfectly. But the Federal Reserve, their increase in interest rates are ultimately having the impact that they're looking for. It is slowing the economy down, and other comments that the Federal Reserve Chairman has made is that they are willing to push the economy into a recession as long as it means tackling inflation. So this is something that we're keeping an eye on, and something that is, I would say, most folks are expecting as a good possibility in terms of 2023 and 2024 in terms of having a recession. Now, if we are to have a recession, what might that look like? And one of the key areas that we are going to look at to assess what a potential recession might look like is the health of the household, the health of the consumer. Roughly 70% of the US GDP is based on consumer spending. So we want to know, how is the average household doing? So what we're looking at here is a graph going back to 1980, which shows the household debt service ratio. So what this graph is telling you is what percentage of someone's disposable income are they having to put towards debt payments. So essentially, how much cushion does someone have between their daily expenses versus what they are required to pay for their debt? And the number that we see here on the far right-hand side of the screen through the third quarter of this year is 9.5%, which we can see over the last 40 years is extremely low, and something that is extremely below where we saw heading into the financial crisis. Another data point that we're taking a look at in addition to this is how much money is in folks' bank accounts or other money market or cash-like investments. And while we're not at the highest peak that we saw during COVID, we are darn near the highest levels of money that is in the average household's bank account. So the fact that people are spending less of their money towards debt and they have more cash on hand leads us to believe that there is a significant cushion, that if things start to get a little rockier in terms of the economy, folks do have a backstop to help make sure that they're able to keep things afloat, which is why we and other economists are hopeful that if we do dip into a recession, that it should generally be more mild than ones that we've seen in the past. So let's dive deeper into what downturns actually look like. So what we're looking at on this particular graph is historical recession length. And this is going all the way back to the beginning of the 1900s through the very short recession that we had during COVID. And on average, you can see that the recession lasts for about 13 months, so a little over a year. And mind you, this does include the Great Depression, which lasted for a little over 3.5 years. So an extremely long length of time. So much like we're about to talk about with bear markets, recessions, when they happen, generally speaking, do not last that long. And it's very important to understand that recessions and what happens with the economy and the stock market are not correlated. Going all the way back to 1930, there have been 19 instances where there has been negative GDP over the course of a year. Of those 19 instances where GDP has been negative, 13 of those times the stock market has been positive. The GDP data tells us where we have been. It does not tell us what is to come ahead. The stock market is the forward-looking indicator that is looking around the horizon as to what could the expectations, be. And as we've just talked about on the last slide, recessions are short-lived. So it takes months for a recession to actually be called. It's generally done a significant amount of time after it has actually begun, because the board that actually calls recessions wants to make sure with absolute certainty that they don't have to go back after the fact and change the start date. So once a recession is hit, this is already old news in terms of what the stock market, has priced in, where they are focused on what is going to come ahead. And so we always talk about how the stock market and the economy are two separate things, and this is a great chart that really illustrates that point. So now let's look deeper into what bear markets or down markets have looked like. So this particular chart that we're looking at shows bull, which is up markets, and bear markets, which are down markets, over the last 80 years. I want to start with the negative first because that's really what we're dealing with right now in terms of the market. So let's focus on all of the orange little dots that we're seeing here at the bottom of the screen. Those represent the down markets. Since 1942, over the last 80 years, we have seen 14 downturns of a similar magnitude to the one that we're dealing with now. And we can see up here in this part of the graph that on average, these down periods last for a little less than a year. Here it says 11.1 months. So there's a few things that are worth emphasizing here. One, we have seen downturns like the one that we're dealing with right now many times in the past, unfortunately. And two, just like recessions, we know that these bear markets do not last very long. And on the flip side, if we're looking at the blue mountain charts, which are the bull markets or the up markets, we can see that they are much longer and they are much stronger. Bull markets on average last about a little less than 4.5 years, and the gain that we see from them is significantly greater. And so, given that we are now midway through November, the current bear market that we're in right now is approaching what we've seen in terms of the average for how long these bear markets seem to last. Now, there are two periods right here and right here where we have seen bear markets last for the longest period of time, and that's 1.7 years. Now, we are not saying that this current bear market that we're in could not extend beyond 1.7 years, but given the amount of data and years that we've seen in terms of market history, we are cautiously optimistic that we are probably closer to the end than we are the beginning. We can see that eventually when we do turn the page and begin this bull market, you can see how strong, again, and how long they generally last from a historical standpoint. So now that we know that a recession might be on the horizon, and we might also at the same time be nearing the end of our current bear market, where does that put us? What can we actually do about it now? What steps should we be taking? Where do we go from here? When it comes to assessing whether or not stocks are a good opportunity, there's a lot of different valuation metrics and data that you can take a look at. One that we are particularly interested in is called the forward price to earnings ratio, or PE. And what it tells you is for every dollar that you put into a company, how much of that is actually backed up by earnings. So what we're looking at here is a chart that shows us what the forward price to earnings ratio is currently, and that's 15.15 versus the 25-year average, which is 16.84. So when you have the price to earnings ratio below the 25-year average, that is a signal that stocks are cheap, which would tell us that now would be a good entry point from that particular metric. We also included price to book and price to cash flow metrics as well, just to show you what some of the other signals are showing us. So when the market goes down, it is never a good feeling, but ultimately, as we're looking forward, we now see that stocks are starting to present a really great opportunity. And to show you additional points to how the market has performed after high inflationary periods, what we're looking at is returns following peak inflation. So this is going back to 1926 and shows you what returns have looked like over the next 12 months. So as I mentioned earlier when we went over the inflation slide, inflation may potentially have peaked in June of this year. And so we can see that on average over the next 12 months at the different periods in history, the average over the next 12 months is a little over 21% for stocks and a little over 7% for bonds. So if our current period should look anything like the past, this could, again, present another good data point that both stocks and bonds, might have some good returns ahead of them. But if you're not quite sold on stocks or not quite comfortable yet with the volatility to get back in there, another great opportunity is now presented itself with interest rates going up. And that is the United States Treasury bill, which we also will refer to as a T-bill. So a T-bill is a bond, a fixed income instrument issued by the United States Treasury that is backed by the United States government. So in the investing space, in the financial planning space, a T-bill is widely considered the safest investment in the entire world because it is backed by the United States government. In fact, a nickname for T-bills is the risk-free rate of return, given how secure they are. And so with interest rates going up, we are now seeing that on a T-bill that matures in 3 months, the annual interest rate is 4.25%. Over the next 6 months, a little over 4.5%, and over 9 months, we're seeing 4.64%. And so even on the bond side of things, you are now being able to earn a pretty substantial amount of interest. So if you have monies in the bank right now, it's important to understand that while it seems safe, ultimately inflation at 7.7% as the last reading is eating into that pretty significantly. So putting some of those monies into a T-bill is a way to at least try to fight back against the very high inflation that we're seeing at the moment. So now let's discuss retirement and tax changes. So these, what we're showing you right now, are in place or set to be in place for 2023. So we're going to see an increase in 401k contributions, where the max contribution for everyone is $22,500. And for those over the age of 50, you have the ability for an additional catch-up provision of $7,500. So if you're over the age of 50, starting next year, you will have the ability to save $30,000 towards the 401k. If you are contributing to an IRA or a Roth IRA, everyone will have the ability to contribute $6,500, and for those over 50, an additional $1,000. So for those over 50, that would bring the total to $7,500. And possibly the best news of all for those that will be over the age of 62 starting next year is that Social Security has announced that their cost of living increase is going up by 8.7%. So if you are receiving benefits, you will see that 8.7% increase. But even if you are not receiving benefits, but you are over the age of 62, you will see that reflected on your Social Security benefit estimate statement. And so don't worry if you're not collecting, you are going to still be able to take advantage of this increase, which has been one of the largest increases by Social Security in decades. Here are some potential retirement and tax changes coming up. None of these are set in stone, but they may be coming down the pipeline. And of course, we're going to make sure that you're informed if any of these do come to pass. The first one is an increase in the RMD age, or required minimum distribution age, to 75. Right now, when someone turns 72, they are required to pull money out of a traditional IRA or other type of pre-tax retirement account. Now, the different proposals that are being suggested may have a graduated scale, so it won't jump immediately from 72 to 75. It may slowly work its way there over a couple of years, but we'll keep you informed on what that looks like. Another proposal is that individuals can make extra catch-up contributions to retirement accounts at ages 62, 63, and 64. So this would be in addition to the normal catch-up where you can save even more. And then lastly, there may be an update to rules for inherited retirement accounts. Beginning in 2020, if you are inheriting a retirement account, you are not required to take annual RMDs or required minimum distributions, but over the course of 10 years, the entire balance must be taken out of that account. Now, there may be an update to the interpretation of the law that was passed where you may be required to take out an annual RMD and then make sure that the entire balance is removed within 10 years. That is not in place at the moment, but it is something where if we receive more guidance on that, we are going to let you know to make sure that we're doing all of that planning appropriately. So now let me turn it over back to Jordan to go over some action items.
Thank you, Sam. Great information. As always, we would encourage you to schedule a review consultation before the end of the year. Ideally, we'd like to meet with you in person, but if that's not possible, we'd want to talk to you on the phone, or we can even schedule a Zoom call. The second item to call to your attention is reviewing beneficiary designations. This is so critical, so important. We've seen situations in the past where someone has updated their trust documents, or they've made a decision to change beneficiaries, but didn't communicate that to us. We would need to make some changes. There would be some paperwork. Please be careful. Please be sure that you're reviewing those beneficiary designations. Ask us, and we're more than happy to help you. An opportunity that presents itself, given the market this year, are Roth IRA conversions. Roth IRA conversions is a great tax planning strategy, although I wouldn't say they're for everyone. We want to look at the economics, make sure that it makes good economic sense. We have software, we have the ability to give you very specific advice on whether that makes sense or not. If it's something you're interested in, let's run the numbers first. And ideally, it would be best to do this before December 10th. That way we know it can be processed before year end. The last item here is referred to as a QCD, qualified charitable distribution. This would apply to individuals that are already taking RMDs, required minimum distributions, and are charitably inclined. The big advantage is the money goes directly from your retirement account to the charity without incurring any taxes. A lot of people aren't itemizing any longer, and therefore their charitable contributions outside of their IRA aren't deductible. There's no tax benefit. By doing a QCD directly from the IRA to the charity, it's a tax-free transaction. And again, we'd like to be able to help you with this if that's of interest, but please let us know before December 10th if possible. Okay, so now we get to the Q&A, and boy, oh boy, have we got questions. They're coming in. I'm going to do my very best to get to each and every one of them. Let's jump right in. Ryan asks, what's the best place? Where's the best place to purchase T-bills? Well, Ryan, that was not a setup question, but your check's in the mail. Dechtman Wealth Management is equipped to help you purchase T-bills, and we can do that right away. It's very cost effective. It's very tax efficient. Something that's worth mentioning is that with these T-bills, you get an additional benefit, which they are free from state taxes. And that's not just Colorado, but that's all states. So that's another perk as well. Please call the office. Please let us know if that's something that you are interested in, and we can discuss the different options available. Rich had asked a question if we would address the FTX cryptocurrency collapse. And yeah, Rich, there's a lot of press on this lately about what's happening in the cryptocurrency market. We think there's probably going to be further fallout in the crypto space, but I have not heard anyone discuss contagion risks where that it's going to spread further into the public markets. We personally did not get involved with FTX or crypto for that matter for our clients. We feel vindicated, if you will, in terms of protecting our clients from those types of risks. So, all right. Another question is, do you have any opinions or advice regarding the midterm elections regarding the stock market? Well, another great question. Excuse me, another great question. When we're looking at this, we've addressed this in the past at length in great detail. You know, the stock market obviously is dominated by what's happening in the elections and the overall economy. But more importantly, here at Dechtman Wealth Management, we focus on the fundamentals. So we're looking at what's happening with inflation and interest rates, and the election results are unlikely to have an effect on interest rates or corporate profits for that matter. Now, whether you're cheering or jeering the election results, don't let that cloud your judgment. If you are working with us, then you have a plan, then you have a strategy. We're focused on the long term and staying the course. However, we want to make sure that we're on the right track, and that's why we strongly encourage you to come in and meet with us so we can make sure we're on the right track as far as that goes. I got another question here. What to do with cash now? That is one of those questions I would refer back to Sam's comments with regard to the market presenting an opportunity. On the stock side, we are very strong advocates of dividend growth stocks. We have fabulous strategies that present tremendous opportunities. On the bond side or the fixed income side, we discussed in pretty good detail the treasury bills. We think that that is a fabulous opportunity and would strongly recommend that. Looks like another question here, Diana, asking about I-bonds. And so the question is a good question. Thank you for asking. I-bonds are also government bonds, and they are in reference to inflation bonds. Now, inflation bonds have received a lot of press, but it's not what it may appear to be. Number one, you are limited to $10,000 per person, period. That being said, and that's per person per year. And the interest rates do adjust. They're only good for 6 months, and they do adjust. You have to hold those for a minimum of 1 year. To get the full benefit, you have to hold those for 5 years. And we feel that the treasuries provide more flexibility. They provide tax advantages, and they can be structured to meet your specific goals and objectives. So, my goodness, we have probably 20 more questions. I'd have to say I'd like to get back to each of you individually, or much preferred if you actually gave us a call or sent us an email and schedule an appointment. We'd love to meet with you and talk with you. I'm going to have to say thank you at this point, and please call the office to schedule your review consultation. Call us today. Our phone number is here, or you can simply send us an email and we'll get back to you right away. Thank you all so much for attending today's webinar. Have a wonderful day. Bye-bye.
Dechtman Wealth Management is here to design your one-of-a-kind financial plan. Call us today for a no-cost consultation.